Hey guys, welcome back to the channel. Today is my Saturday video, and what I'm talking about, you probably read from the from the title, is it's kind of going to be an opinion piece, right? It's what I think how all these income funds would fit somebody, right? How I picture that. Um, at the end of the day, you have to make the decision on your own. You have to look at the pros and cons of each one of these income funds. Can you own them all? Sure. But I'm going to try to look at and give my opinion on what fits what, who it fits, how it fits, and all that good stuff. So buckle in. We're going to talk about it. I'm not going to go too deep into all these funds, but I will link to the videos of all of them because I've reviewed all of them already. So this is just information that I believe is important, right, to your decision making process. So if you're new here, please like, share, subscribe, do all that good stuff. I haven't been saying that in the past couple videos. I think down in the pinned comment below is ways you can support the channel. There's Amazon links where if you click that link, you can go and shop on Amazon, and Amazon will compensate me with a small commission. Now, I do have a book linked down there in my Amazon link that is from Josh Scandlen, and he's from Heritage Wealth Planning. He's the guy that actually got me into YouTube, and he's the guy that because a few years ago I was really stressed out on whether I can retire or not, because I never planned for it ever in my life until like 2018 is when I really decided, okay, I need to take this seriously. And I didn't think I can do anything, right? I thought I would just work forever, and just, die working, right? There would be no retirement. I'd get Social Security, but it wouldn't be enough to live on, etc., etc. So when I found Josh Scandlen at Heritage Wealth Planning, it really gave me hope. It opened my eyes, and it got me to searching, right? And that's how I started this channel. It's why I'm doing some of the things that I do today. So I think that's a great book. Josh is a great resource. He makes a ton of videos, and I was going to put another word in front of ton, but it's, this is G-rated. But he does make a ton of videos. It might be a little too much for some people. He kind of goes off topic and off tangents a lot, but there's very good nuggets of information if you search through his channel, and I'd encourage you to do so. So today we're going to get into it. Like I said, this is basically an opinion piece, and we'll just go over an overview of each one and where I think it fits. So first up, we're looking at is NUSI. This is the Nationwide is on your side ETF. And it's they call it the risk managed ETF. Now what this does is it sells covered calls against the NASDAQ index, and then it buys a protective put down lower, which essentially limits your downside. So what this does, it's called an options collar. So what this does is it gets you income from the covered call, and then it protects your downside from the put. So it really limits both ends of the spectrum. You limit your upside, but you get paid for it. And you limit your downside, but you have to, the out of the call premium is how the downside protection is bought. That is, I think, one of the better ways to do it. If you're looking for a high income level with minimal downside, right, of all these income funds. Now, I mean, of course, it's subject to human error, because somebody has to buy those puts. Someone essentially has to say, okay, I think the market's going to go down, or not going to go down so much, so we'll buy the put at X amount. So that will limit how much downside it can go. For instance, just recently we've had this kind of downside move, right? But NUSI has put on a put that's about 9% out of the money. So until the index or the share price falls 9%, that protective put really doesn't do anything for you. Okay. But it will limit it at that. So if we had a market crash, you will lose much more than 9%. I hope that makes sense. So NUSI has crash protection. I know we always talked about it, downside protection, but it's more crash protection. So, and that's what it says there, seeks downside protection. I kind of wish they would call it crash protection because it uses a constant, fully financed market hedge that seeks to reduce downside risk, and it's downside crash risk. Now, NUSI is probably going to be steady Eddie, about 7.5 to 8% distribution yield per year, paid out monthly. So this is kind of just like QYLD, but with a protective put on the bottom. So who would want this? Somebody that doesn't like extreme volatility or are worried that the stock market is going to crash, and you want to limit your downside. Because if you limit your downside, usually your upside, stays greater, if that makes sense. Next up, you have QYLD. Now, QYLD is just NUSI without the protective put, essentially. So you'll see QYLD pays about 12% a year, and NUSI was 8%, so it costs about 4% for that crash protection. But that crash protection is kind of important for some, right? Because you're looking at, if you look back to the March crash, right, 2020, where we dropped about 30, I think it was 35%. I'm just thinking off the top of my head, but it was right around there. QYLD fully participated in that crash. Okay. NUSI, on the other hand, only dropped about 10%, maybe 11, somewhere in that range. So it completely outperformed QYLD to the downside. So that's really important, right? QYLD is going to give you a higher monthly income, no doubt about it. But if there's a crash, if you're concerned with a crash, then QYLD is going to participate 100% fully in that crash. QYLD does the same thing as NUSI. They sell cover calls on the NASDAQ index and distributes those distributions to you every month. So, could this work? I think so. But I think one trick, especially with QYLD, is if you are living on the distributions of QYLD, you don't want to live on them fully. Okay. So say for instance, you got enough money in there that you're making $2,500 a month. You might want to just take $2,200 of that and reinvest $300. So what that will do is that will also compensate you for inflation. So you'll always get raises along the way. Every single month you'll get raises. And it will also protect you and have you buying on the dips in case of a crash, right? So you'll be buying all the way down to the bottom. That's important too, because, if you're taking fully, for instance, QYLD currently has the policy of paying 1% per month on the share price, basically what they call the NAV, the net asset value. So if it's trading for, I think it's trading for like $22, $23 right now. If it crashed 30%, and what would that be? That would be, let's call it $6. So if it crashed 30% down to $16, your income will fall 30%. I don't know if a current retiree could handle that, right? If you were living on it, for what it's paying out every month and you were spending it all. That's what I'm saying. So I think the key here is to reinvest portions of the distribution back into QYLD so that it keeps up with inflation and gives you raises over the years. I have other strategies for that, but that's essentially what you would do. I think that's good for any income fund that you plan on living on, or that you are currently pulling distributions from to live on. I think that's important. Next up, JEPI. That's from the JP Morgan. This one's growing fast. I like it. It's up there with one of my favorites. I think this one could actually be a core holding in someone's portfolio. QYLD and NUSI, not so much. I think it could be a core holding of your income fund, right? But for JEPI, I think this could be almost a core holding of your entire portfolio. And then you can add maybe the NUSI and the JEPI, or the NUSI and the QYLD, as kind of satellite holdings. But JEPI, they are a little bit unconventional in the way they do things. So they do not track an index. Okay, this is an actively managed fund. Now they pick their stocks. They take about 80% of the net assets, and they pick low volatility stocks from the S&P 500. A lot of people have this one confused where they think it tracks the S&P 500. That's not the case. They just pull stocks from the S&P 500. They're not trying to track it. So 80% is going into just S&P 500 stocks, handpicked, and 20% are invested in what is called ELNs, equity linked notes. Those are kind of like bonds in a way. They're fixed income instruments that within those instruments are being created, is where the income is created. So covered calls are probably being sold in those, things like that. It's a fixed income instrument. So 20% is being paid, or is generating the income that JEPI pays out. I hope that makes sense. So it's unconventional. I think this one will give you the most growth if you're just comparing NUSI, QYLD, and JEPI, just for the fact that 80% of their portfolio is not capped with a covered call. Okay, QYLD is capped with covered calls. NUSI is capped with covered calls. JEPI, 80% of their portfolio is uncapped. So when I say uncapped, there's no covered calls on 80% of their portfolio, which is the stocks that they picked. So those can run and give you capital appreciation, while the ELNs, that 20%, can give you the current income. Now, the income is not so steady with JEPI. Why that is, I'm not entirely sure. It could be they're changing out ELNs. I haven't paid extremely close attention to their portfolio, but I anticipated that JEPI came out with a huge bang. They were giving out like 11-12% dividend yields, and I didn't think it was sustainable. I thought they would settle in between 6 and 8%. Just looking at, the way the portfolio was constructed, it didn't make sense. And I think that's where they're settling in now. So if you look at the dividend yields over here as of March 31st, 6.52 dividend yield, 30-day 8.74. So that's exactly where I think they would fall and where they will stay. Now, JEPI, really cheap. This is why I say it could possibly be a core holding. For an actively managed fund, it's actually very cheap at 0.35%. Now, last on the list is DIVO, is the last one that I have come across and reviewed. And this one I really, really like. If you don't need a ton of dividend yield, DIVO is really nice. It really replicates what maybe an individual investor would assemble as their own portfolio, right? And write covered calls on. So they only hold about 20 stocks. right? And they opportunistically, this is what I like about it. DIVO seeks income from dividend paying stocks. And by opportunistically writing covered calls on those stocks, and I wish they would detail that a little bit more, because it's covered calls on some stocks. I guess opportunistically probably fits there, but they don't sell covered calls on the entire portfolio. They look for positions that might be overvalued, run into the top, and then they'll look and say, okay, we're good selling covered calls with this one. If it keeps running, we're good with having it called away. And I think that is what, a retail investor would really do, a small time investor would really do on your own. Now, this just cuts out your own decision making and all that. And it actually pays you a pretty decent, it's right around 5% dividend yield. And, you can do that with just one investment instead of trying to manage it yourself, because, you can go ask Dave over at Hidden Freedom Investing. He had, 20 some stocks in a portfolio, and, he said it's a bunch of work. And I agree. It's a bunch of work to try to manage all those positions and get covered calls from them if you're going to do all of them, So DIVO is a nice option for that. So this could be a core holding, right? Because as an individual, you'd probably only buy 20 individual stocks anyway. So I think it could be a core holding. I still think, you could possibly have like a total market index along with this, and even with a NUSI or a QYLD, and have a good rounded portfolio, right? You have your total market index, you can have your DIVO, which has some very high quality, blue chip companies in there, generating income for you every month. Then you can have a QYLD or a NUSI to really boost your income. So it could really balance everything out, right? So that's DIVO. I like it. I like it quite a bit. I'm not there with investing in it personally, but I think DIVO fits a lot of people, right? There's some like, for instance, I'll probably review this one, pretty soon. There's one called Noble, and that's the Dividend Aristocrats ETF that is very popular. That isn't as it doesn't excite me so much, and just because it's the Dividend Aristocrat is why it's popular. But I think DIVO could perform right in line with that, probably give you a little bit more income, and I don't know. Anyway, I'm rambling now. So if you made it this far, let me know your thoughts. Where does it fit you? Which one of these fits you, right? Where do you think it would fit you? I think as a retiree or as a near retiree, these are definitely things you need to look at, because they all have their nuances, right? So for me, currently, I'm just in NUSI, but I'm using it personally as just kind of a cash account holding. I'm not living on any of the income. Now, if I were to retire and just have to have income, and I wasn't doing anything to generate any other income, and I had enough to put in there, I would probably do something like DIVO along with QYLD. Something like that. I'd want to heavier weight it to DIVO and then have a boost with QYLD. I haven't mapped that out yet. Haven't done any math. I'm just thinking off the top of my head. Like I said, it's more of an opinion piece. So if you guys have any questions, comments, concerns, leave them down below. Like, share, subscribe, do all that good stuff. Check out my Amazon links. Check out Heritage Wealth Planning as well. Check out Dave at Hidden Freedom Investing, because he's about to retire and he's looking into these. So could be a nice way to get his thoughts and check out his videos about that. So you guys have a great weekend. We'll talk to you later. Thanks. Bye-bye. I am not a financial advisor. The information contained in this video is for entertainment and informational purposes only. It is not intended to be investment advice. Please seek a licensed professional for any investment, tax, or legal advice. Thank you.